Good afternoon, everybody. There's our closing bell. Welcome to Selecting an Option Strategy. I'm Connie Hill. We meet every week at this time and discuss, based on market conditions, what we're seeing, what kind of strategies might be effective in the current market. Strategy we're going to talk about today, actually, we haven't talked about a whole lot, but it could be very appropriate in many different market conditions. I'm going to kind of leave you hanging there just a little bit. I am joined in the chat by Barb Armstrong. I'm glad Barb's there. She's a great veteran of the markets. She knows this strategy inside and out that we'll talk about. So as you have questions, feel free to chat those in. I'll keep an eye on the chat, but there could be some things I can't quite get to, and so Barb will help pick those up for us. Now, I hope you're following us on X. I'm Connie Hill CS. She is Barb Armstrong CS. We'll post educational content, sometimes motivational, or informational types of things that we think you might find interesting or helpful. Okay, it's free. Just sign and follow us, and you'll get those little nuggets throughout the trading day. Let's go ahead. Let's go through our disclosures and lay out our agenda for today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and education. Don't consider it a recommendation of any sort. We'll be using the Paper Money software application. That's the most robust version of Thinkorswim. It has a lot of nice tools for option traders. We will not take fees and commissions into consideration here, but know when you're making your decisions, make that a part of your consideration, because multiple leg option strategies involve multiple transaction costs. When we talk about probabilities, they are theoretical in nature and are not guaranteed. Past performance of any security or strategy does not guarantee future results or success. One thing that's a little bit different about Paper Money than from a live account is that short options in a live account can be assigned anytime up to expiration, regardless of the in-the-money amount. Paper Money does not mimic that same thing. And so it won't assign early in situations where maybe the real market might. And so we like to make you aware of that. All right, coming up, what have we got? Events coming up. We've got the Anaheim Advanced Options Workshop. That might be full. I'm not positive on that. If Barb happens to know, she might tell us. But if you haven't signed up for it yet and you want to, do so quickly, because these fill up and then they cut off registration. So May 30th and 31st, and then 2 market drive events, one down in Miami, June 13th, one in New York, June 28th. They're great events. They're free. We are so incredibly nice to you when you come to these events. We feed you and we just treat you like gold, and you walk away with a lot of information that you've been able to soak in over the course of that day or 2 days, depending on what it is. All right. That was our announcement. We can check it off our agenda. We always want to look at market conditions, see what's going on, discuss which option strategies might make sense depending on the conditions. And then we always want to look at a lot of examples, including following up on some trades that we may have placed in earlier sessions. Let's hop on over. We're going to go over to our SPX chart. And maybe I don't need quite as much room now. I'm going to move this just a little bit. Got SPX up. Let's see, did it finally end on a positive note here? Oh, it didn't. Looks like it was down about 23 points. SPX, let's zoom in here. We can see this blue line heading up. That's our 20-period moving average. So kind of that shorter term trend is intact, at making higher highs and higher lows. Today, it looks like it closed down just a little bit, not a ton. One thing I would point out to you, because we're going to be using this oscillator here today, is that the MACD is rolling over. When it has these bright green lines, it means the momentum is definitely over, 0. But as those lines are building, they're that fluorescent green, telling us that momentum is continuing to build. When they get into the dark green territory, like what we see here, what that means is that bullish momentum is fading a little bit. It still is positive because it's above 0, that 0 line, but it's giving us an idea that maybe fatigue is starting to set in, at least short term. Okay, and that's really kind of the message we might take away from today's candle as well. looks like a little doji candle, which means the opening and closing price were really close to each other. It didn't wiggle around very much here today. And ends in a doji, meaning neither the bulls nor the bears really had a big advantage today. Now, if we were to go over and look at the VIX, let's pull it up. VIX, we know, is what we use to measure volatility in the market. And really what it's doing, it's looking at the put-call ratios. And if there's more puts being bought, that number gets higher. Well, what would that indicate? That would indicate there's maybe some fear or a need. Maybe somebody's feeling more defensive, or the market in general might be feeling a little bit more defensive if there's a lot more puts being bought than calls. And so as that number creeps up, that lets us know that fear is maybe into the marketplace. Now, just generally speaking, we're off these highs that we had in the middle of April and early April. And we can see the VIX is just kind of coming down gently. Looks like it closed about 18. The 18 level is not incredibly high. It's not the lowest that it has been. Down here in 12 and 11 in the last year have kind of been the lows, but definitely down in a lower area. Now, real quickly, let's just see what the NASDAQ. On NASDAQ, let's see, it looked like maybe it eked out. No, it did not eke out a gain either. It was down 0.37%. Even though it's a green candle, it closed lower than yesterday's close. Okay, same thing here. We're seeing the MACD roll over. So momentum, kind of just that bullish momentum starting to drain off is what that's letting us know. Now, given these market conditions, would you put your posture as more bullish, bearish, or neutral? Okay. Based on just those three charts that we looked at, would you say your own position is more bullish, bearish, or neutral? Now, you're free to chat that into the chat, and I'll look at those. You might just tell your computer screen or the dog or the cat in the room what you are, right? Just to maybe answer that question. Now, let's see. Chris says on Iron Condor, which would be, if we look at our strategies, which we're going to go to right now, could indicate maybe a little bit more neutral strategies, maybe is what Chris is saying there. And so we have definitely bullish strategies, which we've been doing, right? We started doing a lot of those maybe 2-3 weeks ago. You guys maybe did. I didn't until last week, right? Because I was on a vacation. Bearish strategies, there still might be an opportunity here and there for a bearish strategy. If it just drops right in your lap, you might consider it. But it's probably not what we're going to go focusing on, right? We're not going to be trying to look for a bunch of bearish type opportunities. And then we have neutral strategies. Those include an Iron Condor, a straddle. We could probably also put a strangle in there, a calendar spread, a butterfly spread, or a double diagonal. Some of these are helpful to use maybe over earnings periods of time when you're not expecting really big moves. Okay, so as far as what you guys are feeling, Derek says, it's time to take a breath and be neutral. Okay, Brooke says earnings season is over. Trump tariffs are on hold. Those are things to be considered, being reflected in the market. Yeah, I would say it's helping us be maybe a little bit more bullish, but I would say the majority of you are saying, yeah, neutral-ish. Okay, neutral-ish. Now, on these lists of bullish, bearish, and neutral, there's one strategy that we really haven't spent a lot of time on, and it's not even listed here. Wow, what could that be? What strategy might we be interested in that is not showing up here? At least I'm not seeing it. I could be blind. Sometimes I am blind. But a covered call strategy. Now, if you were in the earlier class where we were talking about selecting an option strategy, we spent a little bit of time from a very beginning level on covered calls, and we were looking at the buy right, where you buy the stock and then you sell a contract, or maybe more than one contract. If you have multiple 100 shares of stock, right, you need to have at least 100 shares of stock in order to sell one contract, because typically those contracts control 100 shares of stock. And so if you're going to kind of say, hey, we're willing to sell our stock if you give us some premium, then that could be something that maybe is a neutral, but I'm going to say it's definitely not a bearish strategy. Okay, so we want stocks that maybe are running up, peaking out, or stocks that are maybe have flattened out a little bit and are in more of a little bit of a neutral trend as opposed to something super bullish. Now I'm going to pull up some stocks here. And based on the technical setup, I want you to tell me, and I want you to chat this in, if you think this is something we could use for a covered call. Okay, this is an intermediate level class, so I'm expecting that you know a little bit about these strategies, and I want new people to be able to follow along as well. Okay, so a covered call is we have to own at least 100 shares of that stock. It could be 200 or 300, and then we're going to sell. We're going to put up a for sale sign and say if somebody wants to buy our stock, we have it for sale if you pay me my strike price. Okay, so let's look at a couple of examples along this train of thought. So let's jump over here. And the first one I'm going to bring up, and I'm going to show you where these came from. Some of these ticker symbols, most of them that I am going to use, are actually just ones sitting out in my account right now that we did for various purposes, whether it was for a post that I did on X, or whether it was I was substituting in a class and I wasn't going to be following up on the trade necessarily. They kind of ended up in this unallocated bucket. So the first one we're going to look at here is AGI. Okay. Now, as we look at AGI, we know we already hold the stock. And in legging into a trade, typically, we know that we're holding the stock. We're happy with the ownership of that stock, but maybe it's run up. It's starting to peak out. Maybe the MACD is rolling over. And so we're looking to maybe bring in a little premium while the price of the stock pulls back. So this is one we do already have. Would we consider doing a covered call here? I'm curious to know what you are going to say here. I'm going to kind of answer the question maybe a little bit before I get your answer, okay? And the answer on this one is it's not a bearish strategy. There are not enough calls in the world that you can sell to help offset something that is starting to downward trend. Now, some people might have a very long-term perspective, and so they might be using something a little bit longer term, maybe a 200-day moving average or 100 or something like that, in which case, maybe it would make sense for them, okay? They might decide to let it run up here, maybe a little bit more because that momentum is just barely starting to build. It hasn't even crossed the zero line yet. Okay, so those of you that are participating here in the chat, I appreciate that. Most of you are saying, I don't think so, or I wouldn't do it. So a couple of you are saying, well, it depends on what the price is. Well, let's go look. We bought this stock for a price of $25.06. We're actually up on it just a little bit, right? We're up, it's a $25.53, so it's up almost 50 cents per share. So we're up slightly in the trade. Okay, so again, I think it's your perspective. Somebody's Zen says, maybe we'd put a collar on it. And that certainly could be a consideration where you sell the call and buy a protective put together. And usually the proceeds from that call that you sell can pay off a good chunk of that put that you might buy. Okay, let's look at another one. Okay, this is Avgo. We've got 400 shares of it. We are up really nicely in this trade. 190 is our cost basis, and we are currently, I shouldn't say we, but the stock is sitting at 251.53. So let's look at this one, AVGO. All right, well, first thing that's going to stand out to us is it's an expensive stock, okay? Closed today at 231.68. So number one, it might not be suitable for all accounts. Just for 100 shares of stock, you're going to have to tie up over $23,000 for 100 shares. Okay. Well, what about the trend of this? Is it kind of going neutral to bearish, or I should say bullish to neutral? Okay. If we look at that here, the 20 days heading up, looks like maybe it's kind of hitting an area of maybe some resistance. timing wise, okay, yeah, that's kind of the timing that we might be looking for. The MACD is letting us know the momentum, the bullish momentum, starting to roll over, starting to run out. It really hasn't pulled back yet, which timing wise, if we're going to leg in, that might be the right time to sell a covered call. Okay. Why? Because the price is higher on the option. And if the stock really does drop, then the price of that option will drop as well. So we sold it up here and then it starts dropping. Okay. Which is favorable to somebody that's just sold an option. Okay. Now let's see what you guys are answering me here. Brooke was saying the other stock had decent support at 24. I would sell a call here. Somebody says, yeah, sell some calls above resistance. Yes, sell calls. So most of you are saying technically, since we do own the stock, maybe it might be a nice setup. So we're, again, we've talked about price. You got to make sure you're working with the right price of stocks for your account value. Somebody can tie up $23,000 easily. Yeah, then they might want to sell a contractor's for every 100 shares. So many of you are saying, yeah, I'd sell a call. Ron says, sorry, at resistance. And I would say it's actually not a sorry, okay? Because that's kind of what we're looking for. We're looking for the stock to have rallied up, maybe just getting a little bit weak, going a little bit neutral, so we can sell that call at that little bit higher price, okay? And on this one, yeah, we have a lower cost basis. So yeah, we're definitely up in that trade. Let's look at one more. Let's look at BMY. BMY, Bristol Myers Squibb Pharmaceutical Company. This one is a downward trending stock. It's been making lower lows, lower highs. So definitely not in a bullish trend. Now, some people might be tempted to sell a call. And if you're a long-term holder of it, yeah, you might be tempted to because the stock is just rallied. Maybe this 47, 48-ish area might act as resistance because it acted as support here, acted as resistance here. So it might just be running up, getting ready to roll over again. And so for a longer-term position, somebody might. However, for maybe, say, an intermediate type position or short-term type position, yeah, we really want to have something that has more of a bullish trend on it than a bearish trend. Okay. One more. HDB. This is a bank, a foreign bank. Now, what would we say about this particular one? We see it's got a high here at 75. Since then, it's kind of, making a little bit lower highs. But it's also making a little bit higher lows. It's kind of like it's worked its way into this triangle type formation, and we're looking for it to break out. Okay. And it could break to either direction. All right. And so I'd say, yeah, that's getting about as neutral as you can. And here we have about, 6-7 days in a row where it's more neutral. Greg says, oh man, dump BMY. Yeah, it's definitely a downward trending stock. Okay, very good. I appreciate your cooperation playing along with me here. We're going to shift gears for just a moment, and then we're going to circle back to covered calls again. I want to spend just a snippet of time, and I want to look at a couple of trades that we put in last week and just see what happened to them. All right. Last week, we put in a long call vertical. We put in a couple of long call verticals that we're going to report on. Now, this first one was really quite interesting what happened. Class, market's closed, so our orders don't go in until the next day. Okay, so here was PLTR. We were looking at it here on this day, and it was looking like it was trying to break through resistance here. It wasn't like it smashed through resistance yet, but we went ahead and took the order. And you're going to see here, I've got a green oval and a gold oval. The green oval typically identifies the day we got into a trade. And that's when we got in. And 3 minutes later, we were out of the trade. Let's go talk about this. I'm going to go to our monitor tab. account statement. Let's put in our PLTR. And I just have it going back 8 days so we see when the order went in. And so on this particular one, we said, all right, we are interested in getting filled in a long call vertical here, knowing it would cost us about 80 cents. Well, it cost us a little bit less than that. We got filled at 75 cents. Sweet. At the same time, we put in our order, we said, and if we get a chunk of the gain, if we get a chunk of the max gain, we're getting out. We are not going to hold on for every little last penny. We're going to be happy campers to get out maybe a little bit early. So we had put in here for $1.64. If we could sell it for $1.64, we'd be happy with that profit. Well, what happened to us all of about 2.5 minutes later? It filled us. Okay, it filled us, and it even filled us at a really nice amount. It gave us $1.80, 16 cents more than our 164. Now, when we work out the numbers, it looks here like we had $1.05 gain per contract. We were working with 18 contracts, so that was over an $1,800 gain, not including commissions. Okay, so pretty decent gain on that one. Now, I want to explore a little bit, why did we get filled on our get out of order, our exit order? Why would it fill us? I mean, the look on the chart doesn't look like we really moved a whole lot in 3 minutes. Okay, the stock opened there, or actually it opened here, closed up here a little bit. If we looked at a daily chart, we might see that it ran up here quickly. I don't know. The one thing that can happen, if somebody else has an order sitting out there to execute on conditions and trigger a market order, that market order can get matched up with anybody. Yeah, you guys are saying, how did that happen? I never get so lucky in my account. It's not very common. Okay, it's not very common. But if somebody has an order sitting out there that they just want to get filled at a market order when the condition's met, that market order says, fill me at the next available price, and they can go and just match you up to somebody else, your order, to somebody else's order that is a market order. Okay. I don't know for sure if that's exactly what happened, but that's going to be probably a best guess as to why it did occur. Okay. Has anything happened like that in somebody's live account? Probably. And other traders that I know have received favorable market fills on those market orders, but sometimes you don't get as favorable as a fill because that market order price is not guaranteed. So it's just something I want to make you aware of. Okay, don't count on this happening a whole lot to us, although we have had in our example paper account, we've had listing fills that will work out to our benefit. Now, next one we want to look at is Tesla. Okay, Tesla's been recovering nicely here. Put in, after the sell-off, kind of what we might call a U-bottom. Okay, technicians like to see new bottoms because not new bottoms, U-shaped bottoms where it's just forming a basing pattern. Okay, which really typically can be an accumulation of the stock period. Okay. And then we start to see it take off. There might be others of you that might be looking at this and go, oh man, look at that. That looks like a cup and saucer type formation. If that were the case, then we're expecting the stock at some point to get up to this peak up here, about 488. Okay, it was quite a long way away from that, but that's what would be looking at here. Now on this trade, let's zoom in here a little bit. And just kind of see, this is the day we were looking at it. We were seeing it break out. We got filled the next day. They gapped higher. All right, so it filled us here. And then it's just kind of been bobbing along, not doing a whole lot. We have an order sitting in this. We come out here to Tesla. We got filled at 220, which is the same price that we put in for our debit. And we've said, hey, if we can get filled at 416, we're going to be happy campers. We'll see if that happens. And if we go to working orders and we look for our Tesla order, we're happy at 416 right now. It's at about 267. Okay, so it's making favorable progress. The stock just hasn't moved a whole lot for us, but we're going to let it keep working. Okay, and if we get to a point where maybe, say we're looking at it at the end of the week, it doesn't even have to be the end of the week, and we're getting close to this price, we might consider maybe getting out at $4 or something else. Okay, but that's where that stands. Any questions on that? If you do, go ahead, submit those questions. Barb and I are here to answer your questions. Now I want to circle back to some new covered calls trades. And I want to talk about maybe some things we might look for a covered call trade, because we haven't talked about it a whole lot in our class. So item number one is, let me get my notes in the right spot because I want to cover these in the right sequence. Number one is going to be price. And I'm going to say price because you've got to make sure that you can afford it. Okay, that you can afford to tie up 100 shares in your account. There may be some smaller accounts that are like, man, I've got to have pretty low price stocks in order to have that happen. There are going to be others of you that have a fairly sizable account that maybe that's not as big of a concern. But if you have a smaller account, you might look for something in the neighborhood 40 to, I'm going to say $80. Some of you might even go a little bit lower. Some of you might even go down to say $20. Okay, in fact, I'll adjust it. Let's go $20. Okay, you'll have to kind of see how that fits. Next up, for a good candidate, you want to make sure we've got a trend. Some of those trends of stocks that I showed you, like BMY, they're not the right kind of trend that we're looking for, right? We might look at that and go, man, that thing is setting up for maybe a bearish rollover, maybe looking to get in on a bounce down off resistance as a kind of a continuation pattern here. So we want to make sure that, again, that the stock is a little bit more to the bullish side. And so I'm going to put on here, I'm going to just put a plus sign, okay, on the trend. We want it to be positive, and it can be positive to neutral, okay, but just not downward trending. All right, next, entry signals. Now, we haven't spent a lot of time on that. We looked at a couple of things. What kind of an entry signal might you look for? Well, if you're buying the stock and selling the call at the same time, the examples we looked at were kind of the legging in approach because we already had some stocks sitting in our portfolio. What we're going to, on the next part of the covered calls, we're going to talk about buy right, where we buy the stock and sell the call at the same time, just one fluid motion, okay? In that case, we kind of maybe want that stock to have it definitely looking more bullish to neutral, but also maybe being at a little bit higher price. Maybe it's run up to resistance so that we can sell it at a little bit higher price. So first one we're going to look at, and then we'll talk through the rest of the steps here. Look at Verizon. Now, where did Verizon come from? Verizon came from our class watch list that we're using. We created this watch list in our short verticals class on Thursday, but we're using it in this class as well. And all I did is I took the watch list and I sorted it by the last price. I added a column in here for last so that we had the lower price stocks coming up towards the top. And then you can see, yeah, the real expensive guys, Costco, Netflix, they're down there on the bottom, okay? Just because I wanted it to be able to maybe meet some conditions for more people's accounts. Okay, now this stock, you might look at it and go, that blue 20-day moving average is kind of drifting down, isn't it? It is, but what I'm looking at here is that it looks like it broke out of the triangle and looks like it broke above resistance yesterday. Okay, I'm going to kind of zoom in here. And so some traders, this day it wasn't really conclusive if it really broke through that diagonal resistance. Yesterday is a little bit more clear. It looked like it was going to have some continuation today. It didn't a whole lot, okay? But the momentum on the MACD is showing, yeah, that it maybe is still on the positive side, right? and bright green, meaning possibly still building. But the candle today showing some fatigue, isn't it? Showing like maybe that's all we're going to get on that run, and maybe it's going to roll over. This may act as support. It may not act as support. Okay, we'll just have to see tomorrow. But if somebody were interested in getting in here and saying, you like the price of the stock where it is now, you like the fact that it broke to the bullish side, and so you're feeling maybe a little bit more bullish on it than you were bearish, okay? And if I were to throw on the 10-day moving average, let's do it real quick because it's an even shorter term moving average. If I just go simple moving average, we make this guy 10. Got to change his color. He can't be the same color as the 20. So I'm going to make it purple. And we'll kind of maybe go like a 3 on it. It looks like it's starting to maybe drift up a little bit. So this one is definitely only slightly bullish to mostly neutral on that. Okay. Let's go ahead and let's talk through the next sequence of questions to determine, hey, is this a good covered call buy right opportunity? So we're going to come over here to the trade tab. I picked through some weeklies. Many traders like to sell when they're selling an option, whether it's a covered call or if it's for a spread situation. Kind of a sweet spot many traders like is 20 to 40 days. Sometimes it goes a little bit longer. Sometimes you go out there 50 days, just depending on the timing of the options that are available. And so on this, what have we got available? We have these weeklies that are 24 days. We have these monthlies that are 31 days, kind of right in that pocket between 20 to 40 days. We also have one here at 38, and then this 59 goes a little bit further out. And sometimes that may be appropriate for some people. Could you sell even further out? You could. You could bring in a bigger premium if you sold further out, but there's something really important that wouldn't be working in our favor, and that's time decay. When we buy time or sell time quite a ways out, that theta value is not very big, right? The ones that are closer and have bigger theta values or time decay values are these that don't have as much time on them, okay? Now, I did examine the June 13s, but I didn't find anything compelling, okay? So we are just going to open up the June 20s, the monthlies, and see what we have here. Going to come down the call side. Open interest column is right here. Volume is right here. So we're going to be looking in here for activity for some decent volume, right? And some open interest in our maybe low 40s to high 20s of a delta. So we've got a 47. That might be a little high for some people. It's just barely out of the money. 39 delta. We've got 31 contracts here. Whoa, there's a big sea of contracts, which is nice. We've got a 32 delta here. We've got in the neighborhood of 300 plus, probably by the time you add on today's activity there. And a 25 delta, 5,700 contracts. One of the keys we need is lots of open interest, lots of contracts. So I'm going to put that as our next in when we're deciding what strike price to sell. So I'm going to put strike price up here now. We need to have something in a delta that we like and open interest, okay? There might be some of these that maybe say had a delta that you were comfortable with, but let's take this one. It's an 11 delta, which really is pretty low for what we're looking at 32 contracts of open interest. We're going to poo-poo that, okay? We want to be out where there's lots of fish in the sea. We just want to be a tiny little fish in that sea of contracts, okay? Based on that, maybe somebody might feel comfortable at the 25 delta. We're actually going to go with the 32 delta. Some might be comfortable here, more comfortable with lots and lots of activity here. But notice the bid-ask spread here. The one we're going to do is the 45.50, 49 cents by 53 cents. Having a lot of open interest helps us get narrower bid-ask spreads. Okay. The closer those are to each other, the better. All right. So looking at this, there's about 4 cents. Now, let's go through it mathematically. All right. Let's open up our calculator here. What we're going to do is we're going to take the difference on the bid-ask spread, and you could do this for any one that you're looking at. We'll use the one we're looking at here. We're going to take 4 cents. So we're going to take 0.04 and divide that by the asking price, which right now looks like it is, get it right, 53 cents. That's about a 7.5% spread. Is that good? For some people, it might be good enough. Okay. If it wasn't good enough for you, you can experiment with different strike prices and see what there might be. Many times people that are, kind of using some guidelines might say, as long as it's below 7 or 8%, they might be okay. When it gets to about 10%, that might be a place some people draw the line. They're like, that is too big of a spread. What could make it too big of a spread? Well, if you don't have a lot of open interest, that could make it be a wider bid-ask spread. If there's a lot of volatility, okay, say you've seen those days, we had them, a month ago, where prices were just really dropping, the market was dropping, and the bid-ask spreads, they got wider. Maybe normally they were trading at 10 cents, man, they were trading at 20 cents and 30 cents and 40 cents, okay? So that could be a reason why it's a wider spread. And so we're trying to be picky about that. Okay, since this falls at 7.5%, we're good with it. Okay, now let's go ahead and place the trade because we are going to track these. We're going to see how they do. Now, if we put a for sale sign on it and sell this option, we have to be willing to let somebody else buy the stock from us because we've just put a for sale sign up. We've said, if you will buy it at $45.50, yeah, we're going to give it to you. We are going to keep the gain in the price of the stock. Hopefully we get filled somewhere around this $44.22. So we get the gain in the growth of the stock from $44.22 or whatever we get filled out to $44.50. So we get that much on the gain of the stock. Then we get that extra little premium from the call that we're selling here. If we're going to just put this on right now, go anywhere on this line, do a right mouse click, select buy, and then you're going to choose covered stock. Now, I am curious in this class, how many of you have traded a covered call, either in your live account or a paper account? How many of you have traded? Go ahead and answer in the chat. I think that would be interesting to know on that. What did Chris say? The market being closed might make the spreads a little bit wider. Absolutely true, Chris. Thanks for bringing that up. Normal says, selling 60 to 90 days out, otherwise there's very low premium. This is kind of a lower price stock. And the other thing that I looked at here was its beta. Its beta is pretty small. It's showing there about 0.39. Well, what does that mean? Well, for the average stock on the S&P 500, or if that index, say, moved $1, the expectation is that Verizon would move about the beta, 39 cents. So it's significantly lower than the average stock on the S&P 500, which is a value of 1. So in this scenario, maybe it's not ideal for that per se. I would agree we're not getting a really generous premium, but the other conditions of the setup are decent. And so those of you that are actually trading the strategy, Priya says you have in both of your accounts. Vic says yes today. You even traded them today. Greg's a yes. Alec is a yes. Yes, but always a separate transaction. That's fine, Brooke. Yeah, you might be doing the legging in approach when you're saying a separate transaction. Great. I'm glad you guys are knowing of the strategy, practicing the strategy. Life of the Fast Lane says, yep, frequently. They like to use this strategy. Okay. Let's go ahead. Let's submit this. I want to look at another example we're going to follow up on here. And what I wanted you to notice is our net debit here, 43.71. So that's definitely lower than 44.22. Why? Because it's taking that credit into consideration that we're getting by selling. the 44.50 strike price, and it just puts it in at a lower net debit. Technically, that can kind of theoretically lower what we might call our break-even point. Okay, and if the stock actually drops lower than that, we might be at a point we might say, we better check and see if this is still worth holding on to or if it's reverse trend. Let's go ahead and send that in. If any of you are new to this strategy and you're interested in maybe getting some beginning input on it, earlier today I taught a class in the Getting Started for Options class. And I'm just going to show you, I think it's posted now. I'm just going to show you when you become a subscriber to the Trader Talks webcast channel, makes it easy for you to find our information. And on our playlist, I'm going to go down here quite a bit, sort of getting started with options. And it's down here, I thought a little bit lower. Maybe I'm looking too low. We are on Getting Started with Thinkorswim, Getting Started with Options. I'm going to click on here to see the entire list. Really not going to play it right now. And right there, we've got the steps to write a covered call. Okay, so this is just kind of very beginner, a little bit slower than the pace we've had here today. So makes it easy after you've become a subscriber. So if you haven't done that yet, I'm going to encourage you to do so. Now, we may not have time to place the trades here, but I'm going to talk to you about what we're going to look at. USB was another stock that came up on our watch list. In fact, I think it was right after Verizon here, USB, it's a US Bancorp. Is it a bullish trend? Yeah, it certainly is bullish. Has it maybe run up into some potential resistance? Well, it kind of looks like it, right? It's having a hard time getting above 45.5, maybe, or 44.5, maybe 45. And our MACD, technically, is it looking like what we might want to see? Yeah, we're seeing that weaken, but it would be nice to sell it up here when the premium's higher, let the stock pull back while we start capturing that gain on the call. Okay, while we start saying, great, it's melting, 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 we're happy campers about that. On this one, we're looking to do the June 20 options here as well. And this one, you don't have as many choices, okay? If you're okay with the 44 delta, there's 3,000 contracts. What we're going to have to do here, somebody might be comfortable at this 37 just because of the great volume here today. We're going to go with the 46 strike price. Looks like we could get 51 cents out of it. And so that is the one that we're going to sell. We're only going to buy 100 shares and sell one contract. It would be nicer if this had more open interest. Okay, it doesn't. With one contract, we should be reasonably okay. So we're going to say a buy a covered stock. Net debit is lower than what the current price of the stock is right now. We're just doing 100 shares, selling one call. We're going to send that one on as well to our option strategies bucket. And then in our closing moments, I'm just going to show you a setup to another one. When our class is over, I'm going to go put this trade in, and it's going to be on GM. Now, GM, you're looking at that, you're like, oh, it's kind of been a little bit downward trending, and it has for a bit. But looks like it's off its lows, and those shorter term moving averages, they're showing the stock in an upward trend now. Kind of sitting at resistance, kind of looks really similar to USB. And so we are going to sell a call on it. And probably the call I'm going to sell is 46. That's what I had anticipated that I would sell. And so hopefully that would be the strike price I do end up selling. We'll take a look at those next week, see how the trade is developing, and talk about how do you manage these trades now that we're into them. Okay. So we talked about our couple of trades. One was magic for us, right? Got us out in 2.5 minutes. Great. We'll take that on any day of the week. Our other trade, Tesla's doing well. And then we're putting on 3 covered calls called a buy right, selling the call at the same time that we buy the stock. Now, if this is a strategy you're really not that familiar with, you might want to go to that webcast I pointed out to you. But I would say your biggest teacher is going to be trading in your paper money account. Anytime there's a new strategy you're trying to understand, if you'll just go out to your paper money account, put on 3 or 4 trades and then watch them. Don't forget about them. Don't throw them in paper money and ignore them. Okay, let them be meaningful experiences for you. Okay, and we've got a lot of people in here that are trading that strategy, and so it might be something that you might be comfortable with here as well. Barb, thank you for helping me out in the chat. Thank you to every single one of you for being here today. We did not have a survey, but if you thought this was useful and helpful, go ahead and hit the thumbs up button on the way out. That'll help other people find the webcast as well. They'll know that you found it valuable, and so that'll move us up in the algorithm as far as directing people to the kind of content that's going to be useful to them. All right. I hope you've subscribed. If not, take the opportunity to do so. This is the last class of the day. So tomorrow morning, right at the opening bell, we're going to start out with Trader Talks for a Wednesday morning. Okay, we'll see you there. Have a great evening. We'll follow up on these trades next week. Bye-bye.